Well, I will just dive right in. And for all of those who are listening in, thank you so much for being here. I truly appreciate it. I have a really special guest on the show this evening. And this gentleman is someone that I just started following on Twitter recently. If you want to follow him on Twitter, this is his Twitter handle. Let me get my screen sharing turned on so you guys can see it. It's Saxena Puru is the Twitter handle. And this gentleman just you give so much information, man, just so much wealth and so much knowledge. How did you start getting involved in trading?
Well, Jeremy, I basically grew up in a family where my dad had his own investment management firm. So he was a licensed broker, and my education was in business. So I basically did commerce and Bachelor of Commerce honors with a specialization in business and so forth. So I was always interested in the financial markets. And as a young kid growing up, I used to see my dad pouring through annual reports and looking at charts and so forth on his computer in those. So that kind of caught my attention. One summer, when I was in high school, if I recall correctly, I started going to his office to basically spend my summer vacations. And I found it quite interesting, and I just got hooked, the idea of being able to, invest properly and generate significant amounts of wealth for yourself appealed to me. And I'm just wired that way. I think my brain is just wired for numbers. I just really like numbers. I like doing what I do. I don't find this as a chore. Some people find this as a drain.
Yeah.
And for them, it certainly is not suitable for those people. But for me, I actually enjoy it. It's one of my favorite pastimes is actually looking at companies and seeing their competitive advantages, pouring through their financial statements and stuff like that, and trying to use my brain to try and see, what these companies are going to look like and what are the options. I just find all this stuff fascinating.
I love that. That's a great story. And would you describe yourself from a percentage ratio of like 100%? How much fundamental and how much technical?
Okay, at this point in time, I would say the vast majority of my work is fundamental based. I would say maybe 95%, 95%. And the remainder is technically based because I use a systematic trend following strategy to hedge my growth stock portfolio. And that's purely technical, so I have no input in that at all. So I have removed myself from the market timing altogether because I know that market timing is very, very difficult. Not many people succeed at this game over the long run.
Yeah.
So what I have done is one summer I actually bought a quantitative software with actually all the strategies, all the indicators, the moving average crossovers, the MACD, and stochastics, RSI, CCI, all the technical indicators which traders use. So I basically just sat down one summer. I think I spent 3 or 4 months obsessively, maybe 8 or 10 hours a day. And then I just sat down and I looked at all the different indicators on daily, weekly, monthly charts on various indices, and also on all the Dow components and also on the NASDAQ components to see which ones actually worked and which ones were a lot of noise and fluff with no substance behind them. And that's when I realized, that most of these technical indicators, Jeremy, which are popularly used, they have no edge whatsoever. I've posted recently some back tests, screenshots of some of my back tests which I've done on, the MACD or the stochastics, Bollinger Bands, and a few other indicators, including the 50-day moving average, the 100-day moving average, the 200-day moving average. And what I have found is that over the last, say, 30, 40, 50 years, a simple buy and hold strategy on the S&P 500 has actually outperformed all these indicators by a wide margin. So that was quite revealing for me and quite telling because, I grew up in an environment, as I mentioned, where my dad used to look at charts. And the first thing he gave me when I was young, he said, look at technical analysis. So I read a few books on technical analysis. And for the longest time, I actually used charts. And I realized, that yes, I was doing well and reasonably well, but I thought, there must be surely more to this.
Sure.
And I looked at one day. I just thought, let me just put on my detective's hat on and just see what has worked and
Yep.
what hasn't. So I poured over, the long-term performances of a lot of hedge funds, a lot of CTAs and so forth, and, systematic trend-following traders and so forth. And what I found was the vast majority of these guys were actually underperforming the market. And what was quite revealing for me is, if you look at the 10-year chart or the performance of the Barclays CTA index, Jeremy,
Yep.
which is available, anybody and your listeners can actually go to Google and type in Barclays CTA index and just look at the 10-year performance. The performance is pretty poor. If you look at the compound annual growth rate of the index itself, it's, I think, 0.2 or 0.3% a year.
Mm-hmm.
And that basically was a big alarm bell in my brain. And I thought, these guys manage billions and billions of dollars. They've got mathematicians, statisticians, an army of computers, the best brains in this business doing this on a quantitative basis using computer models and trend following indicators and so forth. And as a group, as a bunch, if these guys are struggling or they have struggled over the last 10 years or so, what choice, or what chance rather do I have, sitting at my home and band? What edge can I possibly have when some of the best brains in this line of work are struggling?
Yeah.
And then I look at the performances of some of these well-known hedge fund managers, and I found that some of them have done incredibly well over the last 10, 15, 20 years. If you look at Dan Loeb from Third Avenue, if you look at David Tepper and so forth.
Yep.
And then I realized, even here in this field, the vast majority of the managers were underperforming or have underperformed over a long period of time. And the same thing applied to all the mutual fund managers. I think the statistics show that I think 90% or 93 or 94% of all the actively traded funds underperform the benchmark, which is the S&P 500 over a
That's right.
10-year period.
That's right. Yes.
So,
It's at least mid 90s. I mean, it's a high number.
correct. So when I looked at all this and I thought, hang on, if I am doing what these people have been doing for so many years, my results are going to be no different than these guys. That's just my logical way of thinking. So then I looked at more information, and then I looked at the long-term track records of those managers and those investors who had beaten the market consistently over long periods of time. And then I looked at the long-term charts, of some of the dominant businesses in the world, like the Visas, the MasterCards, Nike, Starbucks, and so forth.
Mm-hmm. Mm-hmm.
That's when the penny really dropped in my brain, because I thought, hang on, if I just look at this
Find
chart
some of these.
objectively
Yeah.
over the last 10, 20, 30 years since these companies IPO'd, and if I see the performance of these companies, or their stocks rather, and compare that with the S&P and the NASDAQ, these companies have left the indices in the dust. It's not even a contest.
Not even
So
close.
I thought, yeah, but yeah. I mean, basically, if you look at some of these companies, Jeremy, they've grown wealth for their shareholders at 15, 20, 22, 25% compounded annually over 10, 15, 20 years. And the indices have done maybe 8 or 9% a year, or maybe 7% over the last 20 years.
Mm-hmm.
And when you are compounding your money at a very high rate of return for a long period of time, wonderful things happen. And for me personally, the way I invest now, I look at the companies. I obviously, pay attention to the competitive landscape and try and identify the moat of the business. How durable is this company's competitive advantage, and
Okay.
why is this company able to generate such a high rate of return and generate such a high amount of cash on invested capital for such a long period of time? Because not every business is able to do that. Most of the businesses are unable to do that, and most businesses fail, as you probably know.
Yeah.
So for a business to be able to do that, obviously that business has some amazing characteristics. So then I started, looking at those characteristics, and it was fairly obvious to me. And so here we are in 2019, and I've gone from being a technical commodities trader and a Hang Seng Index futures trader in '99 and 2000, which is how I started off. A long-term growth investor in secular growth businesses.
So, Puru, can you define for anyone who's listening, in your Twitter profile, it's specifically the very first word is mentioned, growth stock investor. So how do you help people understand what does growth mean? I mean, what specific metrics fundamentally help you identify is a stock growing?
Okay, I mean, that's pretty simple. What I do is, Jeremy, I look at the past few years, or at least the operating history of the business.
Uh-huh.
So if a company, say, IPO'd 3 or 4 years ago or 10 years ago, I pull up the financial statements, which are easily available these days. Any of your listeners
Yep.
interested, you can subscribe to morningstar.com. I subscribe to that service. I think it's fantastic. It's very, very cheap for the value that you actually get from that. So you can pull up, the 10-year financials on Morningstar or any other service, and you can see, the in a bar graph form, you can see how the revenues, the earnings, and so forth have increased over time. And you can also these days find services which tell you what the projections are for the next 4 or 5 years from the various analysts who cover these companies.
Mm-hmm.
And by and large, Jeremy, what I found is that the analysts obviously don't get it right all the time,
Mm-hmm.
but generally they're in the ballpark. So if the analysts as a group are forecasting, I make it up, say 25%, compounded annual growth rate for the business over the next 4 to 5 years. It is very, very rare that there is a big deviation from that. 25% may end up being 22% or 27 or 28%, but it is very rare that, their consensus is way off the mark over, say, a 4 or 5 year period. So I look at what the business has done over the last few years and then what the projections are over the next few years, and I take it from there.
I love that. What are there any sectors that you shy away from? So, for example, pharmaceuticals or cannabis or anything like that, or you just if the company speaks to you, it's a possibility.
No, I stay away from a few sectors, and I think that's a very, very good question and a very key, factor in determining whether you will be successful at this or not. There are a few areas which I absolutely avoid at all costs. One is commodities, because the commodities business is terrible. It is a cyclical business which is prone to booms and busts. So the commodity companies which actually mine this stuff or produce this stuff, they have absolutely no pricing power. So they're not price setters, they're price takers. So, the price of the product that they sell is not determined by them. It is determined by the supply and demand dynamics or the market dynamics at that time. And that, to me, is a terrible business, because if you are not able to control your own destiny and set your own prices as a business,
Right.
and you depend on external forces, then over time you will not be able to generate a very high rate of return on invested capital. So also I avoid industries which are very capital intensive, commodities being one. If you want to mine any commodities, you have to set up a lot of, plant equipment and so forth, and you have to spend a lot of cash. So I avoid businesses which require a lot of ongoing capex or capital spending. So commodities being one. Automakers, the car industry.
Yeah, that's a tough one. It's
Terrible industry. If you look at the US, if my, I think if I'm correct, if I can't remember this 100%, but I think I'm pretty correct on this. I think most of the US automakers have actually gone bust in the US.
It's a huge number. It's a huge number.
And Ford is the only survivor, and even that survived because the government bailed it out in the aftermath of the last recession. So if an industry is littered with bankruptcies and hardly any successes at all, then I try and stay away from it. And having said that, for the first time ever, I actually did invest in Tesla briefly in the first quarter. And then when I saw, the contradictory tweets and messages from Musk and, the Tesla newsroom, I sold out my position very, very quickly. I slapped myself on my face for actually investing in this company in the first place. I think I broke even on this particular investment, and then I vowed again never ever to invest in the auto business again. So the auto industry is terrible. The airlines are also terrible. There has been some consolidation in the US, and now I think they've got 4 or 5 different operators in different routes and so forth. But even I think the airline industry is very, very cyclical, very capital intensive. And obviously there is no significant moat there, and that's why the airline stocks have done pretty poorly.
Yeah.
Also, if you look at the heavy machinery stuff, the industrials and so forth, I try and stay away from those also because they are also very cyclical. And if you look at some of these businesses, if you are, say, a customer of Caterpillar or John Deere or someone like that, then if you buy their product once, you're not going to go back 3 months later and buy their product again. That's it. You're done for a few years.
Yeah.
So big ticket items which are sold very infrequently, that to me says that there is a problem. I prefer to invest in those businesses where there is a repeat business from existing customers, or at least a frequent purchase from existing customers, and usually small ticket items and secular growth. So, nascent industries which are just starting out, and there is a long runway for growth. In today's day and age, I would say software is one. I would look at e-commerce, fintech, payments, credit cards, ride hailing. These are some of the things which come to my mind. Most of the spectacular businesses throughout history, Jeremy, have been within the technological or the technology sector. They have been operating at the outskirts or the fringes of known technology. So those are the industries and companies which have rewarded shareholders handsomely over the last 10, 15, 20 years.
I think personally that is incredible insight. And I just want to say thank you for sharing that, because I really do echo those sentiments a lot. And sometimes I just kind of forget that, yeah, if a Caterpillar or a John Deere, whoever is buying those products, they might buy those products, like you mentioned, one time. And it's so expensive to build one of those items. And if you're only buying it once, the return usability and your average customer price is not, incredibly high. But a company, like, let's just say, for example, I'm thinking you're a big fan of SaaS models, is what I'm assuming. Shopify, SHOP. This particular company is just the things that it can do and the amount of people that it can serve and the amount of revenue that it can do every single month hasn't even been untapped yet.
That's right. I mean, basically, I look for companies where there is some sort of moat. As I mentioned, obviously, the stickier a company's product or service is for the customers, the more indispensable they are, the better it is for shareholders.
Yeah. So I'm actually looking at Morningstar right now, and they mentioned they use the word moat as well. What does that mean?
A moat basically means, a barrier to entry. That's your economic moat. That is your durable competitive advantage, which keeps competition at bay. Because, remember, capitalism is very brutal. Because you have free markets, you have availability of lots of capital, you have globalization. So there are a lot of entrepreneurs and a lot of very, very smart people who spot good business opportunities fairly quickly. And they, if they see an area or an opportunity which has very high margins and a long runway for growth, then very quickly you have a lot of competition trying to take your economic castle away from you, like Warren Buffett says. So the moat is very, very important. Without a moat or a durable competitive advantage, a business cannot compound for a long period of time. It just cannot. And that's why I try and stay away from businesses which are flaky in my brain and which lack this competitive edge or a durable advantage. I mean, I'll just give you a recent example. A few months ago, I basically spent a couple of days looking at Canada Goose, GOOS.
Yep.
Growth looked pretty good. The valuation seemed reasonable, not cheap, but reasonable. I think it was trading just over one peg price earnings growth ratio. And then I said to myself, hang on, these downs that they're selling, these jackets and so forth, they are extremely expensive. And they're only suitable for those people who actually live in very cold countries.
Yep.
And this is a seasonal product, because once one person has purchased a really warm jacket in the winter months, he or she is not going to come back 3 months later and buy something in the summer. And more likely than not, that person is going to just stick with this thick jacket for the next few years until it kind of gets worn out, or if that person gets bored. So again, I thought, retail is another one, which is a very, very fickle business. You look at Abercrombie and Fitch, Under Armour, Canada Goose, and so forth. So these companies are growth companies, but I try and put them in the sort of fad basket. And if you look at the retail sector, you see that only a handful of brands have succeeded. Nike, Adidas come to my mind, and Lululemon has done very well over the last few years. But these are the exceptions; they're not the norms. And
Yeah.
I try to stay away from them, no matter how compelling the growth might look, because I try and think, as an investor, what is the likelihood of this company still being in high demand 5 years, 10 years from now? And if I cannot reach a reasonable conclusion, I just stay away.
I love that. And man, I'm in love right now with your analysis because this is something that I tell people when you're talking about learning how to trade the stock market. This is the part that's fun because you get to describe and just talk about more or less basic human needs, right? When you're buying a company, does it match and does it make sense to just simply be a part of this company? How long are they going to grow? So I love the Canada Goose example. I agree with you 100%. Yeti is the other one for me that I'm really, really questioning. And they make good products. I get it. But the competitive, like you mentioned, the competitive advantage, there's so many other companies that are quote unquote knockoffs that are as good, if not better, for 1/3 of the price. And Yeti only makes cups and coolers. And it had like a 200% growth last year. And it was just for, 2019, this year, since it IPO'd. And it's just one that I've missed the entire ride up, and that's fine. But I really just don't see how this is massively different than GoPro.
I agree with you. I mean, I looked at this also, and when I looked at what they do and the valuation this company was commanding, I thought, good luck to the shareholders. I'll look somewhere else.
Yeah.
This isn't the kind of business that excites me one bit. And just from experience, I can share another example with you. Many, many years ago, I invested in Hain Celestial, Hain.
Uh-huh.
And that was the worldwide leader in organic natural foods and so forth.
Yep.
And the company was just buying out brands left, right, and center to try and cater to all sorts of customers. And that did really, really well for a number of years. And then eventually the big players came in, the General Mills and the Nestle's of this world and the Hershey's. They realized what was going on, and then they launched their own products. And even the big supermarkets, they came out with their own white label stuff, which was healthier. And look what's happened to Hain Celestial now. The stock has been absolutely hammered because their growth has come to a standstill, and the revenue, instead of growing, is now shrinking. So that was a big lesson for me. Fortunately, I got out way before this business turned sour because I could see that the competition was actually coming online. And if you look at the recent IPO of Beyond Meat, I think it's BYND.
Yep.
That's another one which actually boggles my mind because, this is a company which is just selling plant-based protein, i.e. peas, and so forth. And they're trading, I think, at 60, 80 times sales.
Yeah.
I haven't checked the multiple recently, but I also read, I think, a couple of days ago that the big brands are also now coming out and launching their own, natural plant, fake meat products. So I think it's only a question of time that Beyond Meat is also going to go down the same way as Hain Celestial did a few years ago.
And the fun part about that one is you and I get to pour over earnings because I think they come out this week on Beyond Meat, and we'll get to find out a little bit more about some insights. But yes, I think that's a really fantastic insight. And that brings me to a question because you mentioned on Hain Celestial that you exited. So let's just talk entries and exits. So for investing, how do you know when to get out? I mean, for example, on Starbucks, realistically, if you just ever sold, you're terrible. If you just ever got out of this thing, or TJ Maxx, or Apple, or Google, how do you know when to get out?
Okay, I mean, there are many ways of doing this. For me personally, I want to be invested in the fastest growing businesses of the time.
Okay.
So, and I also run a pretty concentrated portfolio. The vast majority of my life savings are invested in about 20 to 22 companies.
Uh-huh.
So I run a concentrated portfolio, and I may actually drop the number even further to maybe 15 or 18 down the road. So I only ever want to own the most disruptive, dominant, fastest growing businesses, Jeremy. And I know a lot of people get fixated by the companies that they own, and they, feel very happy when a stock goes up 5x or 6x or 10x. Frankly, that doesn't bother me at all. I'm only interested in compounding my capital, my portfolio. So what I do is I try and look for companies which are currently growing at, say, over 20% per year. And future EPS projections should be a minimum of 20% for new investments, or more like 25 or 30% per annum compounded annual growth rate. So when I invest, I look for the highest growth possible. Obviously, that business must have a moat also. And I check the valuation of the business also. If it's too expensive, I don't invest, I just pass. And when I sell, I try and hold the business, I stay invested in the business for as long as possible, sometimes a number of years. I mean, I own a lot of companies in my portfolio now, which I've owned for many, many years. So as long as the growth of the business is above 15% per year, I stay invested. So if a business is growing at 16, 17, 18% a year, I stay invested. And I also closely monitor what the analysts are saying about the future. And if their future earnings projections are north of 15% per annum, I stay invested unless I can spot a new IPO or a new business opportunity with an even longer growth runway and, a better. Otherwise, I just stay put. And if the growth rate dips below 15% on an annualized basis without an economic recession or downturn, I exit. No questions asked. I don't hang around.
Gotcha. So I like that you mentioned new IPOs. So you are a growth investor that will, when the new IPO comes out, I mean, how do you know when to get in? Is it before it actually IPOs? So you call your broker and you do the accredited investor route, or is it after the IPO? So for example, you mentioned, you didn't specifically say anything about Uber or Lyft, but Uber and Lyft, I personally believe will be here in the next 10 years and it will have incredible growth opportunities. So something like Uber, for example, is that something that would be in your realm of, hey, it's an IPO, let me start entering? How do you know how much to enter? Is it all at once? Is it tiptoeing in? Is it put sales? Like, how do you get in?
I mean, absolutely. What I do normally is, if I like the business and if the valuation makes sense, and if I can buy it on the market, in the public markets at the valuation that I like or that I'm looking for, I buy. I don't wait around to see what the stock will do a month or 2 months from now.
Nice.
I've seen from my experience that in a bull market, which is the state of the stock market naturally for the vast majority of the time, if you hang around and try and save pennies, then you lose the dollars, because the market doesn't care what I think about a company. If the stock is at 10, I have the choice of either paying up 10 now in the hope of selling it at 50 or 100 later, or I can try and be cute and say, well, I'm not going to pay 10, I'll try and wait for it to. When it's at 50 or 100, whether you pay 10 or 8 makes absolutely no difference. Sure. So what I do, I look at the valuation, and if the valuation makes sense to me, and if I feel I can generate a 15% compounded annual growth rate on this company over the next 5 to 7 years, I invest. The charts and stuff don't really mean much to me. I'll give you a couple of examples. Recently, when Lyft came out,
sure,
I invested in the IPO pretty much straight away. I think my cost now is maybe $70 or $72, my average cost. So I think I'm down maybe 10, 15, 20% or something on Lyft.
Yep.
But it doesn't bother me because it's not something which I did for the next 2 or 3 months. I, like you, believe that, ride hailing is a long-term growth story. And, if you look at the growth rate of Lyft, for example, it's growing at 95%, the top line growth in Q1. And this year, analysts are expecting growth of about 50, 55% on a revenue basis. So if I believe that the industry is young and, this is one of the leaders in the industry and that this business is going to be a lot bigger in the future, I just invest. I've also recently invested in Pinterest after the pullback. This is something.
Man, there we go. Now we're talking.
Yeah, I basically saw the big run-up, and then a lot of guys, smart people on Twitter who I follow, they all sort of made positive comments about the company, and then the stock has been crushed recently from I think 35 to about 24, 25.
Yep.
So I've just invested, I think my cost is now about 24, $25 a share.
Mm-hmm.
So I'm breaking even at the moment, but I think that this business has a very good chance of growing very, very rapidly over the next 8 to 10 years. So I'm pretty hopeful that this will turn out to be a good investment.
My man, I'm with you on the Pinterest. Honestly, I have some positions on this one as well, and down on it a little bit. Nothing too bad. I have a. So, do you dabble with options at all?
No, I mean, options is something I stay well clear from. A, much expertise, and B, I do know a couple of very smart traders who trade options on Twitter, and even they've told me, that options is a pretty sort of specialized game, and more often than not, most people lose money on this thing. So I just stay away and stay invested in good companies and
Sure, totally,
hedge, you know,
totally understand.
shorting.
Yep. The reason I was bringing it up is just because I have a covered call in Pinterest, which is just selling a call against the shares that I had. So at some point, I think this covered call expires this Friday, and then I'll turn around and do another one. But yes, I agree with you. This is such an interesting company, and their revenues were actually quite good when they had earnings. And the interesting thing about it, I mean, think about this. And from a consumer standpoint, if I want to buy an ad for someone and they already have their shopping list made for me. I mean, when people go to Pinterest, they go to literally shop. Like they're looking for things they like, that they want to put in their house, that they want to buy one day. And I'm going through as a consumer, or as someone who's selling something to these people, looking through all these ads, getting all this data and going, okay, well, person, here's Peru and he likes this, and this, because it's on his Pinterest board. So I'm just going to sell it to him. Like they're creating their shopping list for all the consumers. Like it's already there. They're collecting so much data. I see this as a very strong candidate for a buyout in the future at some point as well. Maybe not Facebook, but someone's going to be picking up Pinterest. I just see it as a possibility. I mean, I'm not saying it's going to happen, but wow, I agree with you, man. Fully invested in this guy. I think it could have a really good run.
Yeah, I agree. I think it's not going to be one of the big players or the main players in online advertising, because that market is pretty much stitched up by Facebook and Google.
Agreed.
But 10 years from now, I wouldn't be surprised if Pinterest ends up capturing maybe 2 or 3% of the total online digital sort of spend on advertising.
Oh, I like that number. I agree. So Snapchat, then you're probably not a big fan of Snapchat because they're burning money, or is it kind of an interesting potential appeal in the future?
Not really, because I've been a shareholder of Facebook for a long time,
Mm-hmm.
and I just think, social networking, social media is already basically done and dusted by Facebook, because I just think that company's moat or the competitive advantage is so strong, and that the user engagement is so strong, not just with Facebook, but also with Instagram and the other properties which they have, that I just think that Snapchat's going to be, it's going to be very difficult for Snapchat to compete. And also Facebook, recently or a while ago stole one of his main ideas, and incorporated that feature
Yes, which
into
is
its own.
brilliant.
Yeah, I mean, if you can get away with it, why not?
Yeah, I agree, man. And
That's the business world for you. Capitalism is brutal.
that is, it really is. I can't agree with you more. And Facebook, the thing is, truly, there's a lot of people who forget that Facebook owns Instagram. I know that sounds crazy, but a lot of people do forget that, especially, when I'm talking to, let's just say, a quote unquote millennial, someone in my age group, and they're asking me, hey man, what's a good stock pick? Because I get asked that all the time. Facebook is one of the ones I'll bring up because I know they use it. And any company that someone uses constantly every single day, it can become easier for me to convince a person to go, hey, you should probably own it long term. And then I mentioned, by the way, did you also know they own the third biggest social media platform in the world right now, Instagram, and they own WhatsApp, which is huge. And then they own Oculus, which we're going to talk about. I mean, 5 years from now, we're going to be integrating so much into the future of just augmented reality and virtual reality and advertisements and linking. I mean, Facebook's not even close to how high it's going to go in the next 5-6 years. I mean, it's just going to continue to dominate.
Absolutely. I mean, they also own Messenger, and they're also getting into payments now.
Yep.
And if you have a platform, Jeremy, where you've got 2.5 billion people worldwide using not one, but maybe two or three of your products on a daily basis, I would say that is one hell of a moat. And
Yeah.
the valuation of business is pretty reasonable right now. It's trading, I think, at 21 or 22
Yeah.
times year-end, forward year-end EPS, earnings per share. And if the company grows its bottom line at, say, 17 or 18% annualized over the next 5 years, that is the sort of return shareholders should hopefully get from this business if they invest today.
Yes, totally agree. This is a fun one to talk about. One of the ones that flies under the radar for me, for a lot of people, I like, and I'd love to know what you think. Planet Fitness, I think, is a really interesting one, interesting concept. And my thought is, as they continue to grow, because I mean, the share price right now is just going berserk. They have a really interesting business model. Even though their customer service is not all that great, and I don't personally use Planet Fitness, I know exactly how they make money, and they have tons and tons of capabilities and cash that's coming in every single month, right? That monthly reoccurring revenue they don't have to do anything for. And I think they're going to go and start buying a lot of these smaller niche kind of fitness, even though it is quote unquote seasonal. A lot of people like doing it in the beginning of the year. There's also people who do go to the gym, quite often, and they're going to continue spending their $10, $20, $30 a month in masses and droves. And Planet Fitness will continue to buy other smaller, tinier gyms that do have that really good customer service. The Orange Theory Fitness and all these other international brands they're going to start purchasing. This one's one that's flown under the radar for a lot of people. And I don't have a big investment in this one, but it's something that I thought, hey, if you spend $1,000 a year on a gym membership, take $1,000, put it into Planet Fitness, and see if 2 years from now you'll get a free membership worth of money.
No, I agree with you. It's a great business. I've never actually invested in this company, but I studied it a couple of years ago.
Mm-hmm.
And I wish I had invested when I passed on this. But yeah, it's a great business. I agree with you.
Another one I like a lot is GoDaddy. And this is one that has a flavor of reoccurring revenue, but they also have annualized revenue as well. This is a product that, with the digital real estate and software as a service and things like that becoming more and more popular, the fact that GoDaddy controls, and they make a lot of money from just domain flipping, where their robots go scour the internet and just figure out what kind of domains to buy. And they just buy all of these domains. And then when someone's like, hey, I'm going to come up with an idea for a new business, I'm going to call it peruseflowers.com. They already own that. And you have to spend $300 or $400 or $1,000 for the website. And they're making really good money off of that. But their customer service is phenomenal. They do a lot of website building. And this is something that's probably in your industry as well. Have you researched these guys at all?
No, I haven't actually. I've seen the name pop up in many places, but I haven't actually gone through the business. No.
Gotcha. Yeah, it's just one that's that's interesting, and their advertisements that they got them on the board. They did the Geico route where they just advertised so much that they just ended up becoming a household name, and a lot of people use them for a lot of different services. But it's going to be a very interesting product, I think, in the longer term, because so many more people, as they go the entrepreneurial route, will continue buying domain names and using those domain names every single year, and adding on additional products and so on and so forth. So this is another one I like, and I agree with your Pinterest. I'm trying to think of another. Is there any other cool IPOs or new companies that we should just keep our eyes on that you might kind of like?
I mean, Slack is something which is of interest to me, but the value is just so high, so I'll
Yeah.
probably pass. But there's been a few, recently also Square, Shopify, but they're like 3 or 4 years old now.
Mm-hmm.
And for me, I don't really care how old the company is or how old the IPO is. If I like the business and if the valuation makes sense, I invest. If it's a newer company, it's better, obviously, because the growth rate is higher and
Yeah.
your return holder is higher. And I think one key thing which I think your listeners might benefit from is the the insight that you are better off investing in the younger growth companies with a long runway of growth. You are in the mature, sort of old, boring companies, because although the mature and old and boring companies may appear safe and may give you a good feeling, if the revenue growth and the earnings growth has really slowed down already, you're not going to make much money from the investment, because your return as an investor in any company is dependent upon the growth rate of the business.
Bingo.
And the valuation expansion that you get as an investor, or that you might get from as an investor. So if you invest in a company which is likely to grow its earnings tenfold over the next 10 years, all other things being equal, that is the return that you're going to get as a shareholder. You're going to get a 10x on your investment. On the other hand, if you invest in a company, like
Microsoft or Adobe,
or even Pepsi or Coke and stuff like that, you may be at 2x in the next 10 years, maybe 3 max. So that's what your return will be as an investor. There is a very, very strong direct link between the share price appreciation and the appreciation in the earnings per share. They're almost one.
That's some really valuable insight. I do appreciate you sharing that with me. The IPO that I'm most excited about, I'll tell you, when it comes out, because I don't think it's an if. I think they're really working on it. Is Stripe? Have you heard of Stripe before?
Yeah, the payment processing.
Yeah. But their customer service, again, I'm one of those guys that I'm also a big customer service fan, because my thought process is if people like interacting with your service, they'll probably use it more. Kind of like Netflix. I mean, right now, probably not the best investment of all time, but in the recent past, it was. And they have good customer service. Same thing with PayPal. I love PayPal because they're so damn nice, man. Like if you have a problem with PayPal, it's like just give them a call and they're going to fix it, more or less.
Yep.
And we're talking, they now own Venmo. That's one that a lot of people forget. And so they're tracking all of this data, everything that you're sending back and forth. What are you sending it for? How much money do you have? They're just tracking all this. And PayPal, I love PayPal. I love PayPal Pay Now and Pay Here. And that's, a big competitor of Stripe. Not Stripe, Square. But Stripe is kind of its own little niche. I think it has a really interesting kind of an independent flair, and linking with companies like Shopify and like Wix, W-I-X, and having the ability and the capability to really make it so simple for the digital entrepreneur. And that's, when you're talking about your portfolio and your holdings of like 20 and 22, or maybe you're going to pull it down to 18 or 15. I'm in a kind of a similar situation, because I personally feel that you don't need a massive exposure to insane amounts of companies. Diversification for people who don't know what they're doing, right? That's a Mark Cuban quote. And if you do a little bit of research and you figure out what the companies are, you don't have to have insane, like every single dime you have into one particular company. But let's just take Wix, for example. I mean, who in the world doesn't know what Wix does? It's so simple. It's a really easy concept to understand. And this company was at 35 3 years ago, and they're at 140 right now.
Correct. Yeah. I agree with you. I think if you are basically, able to determine which are the good businesses, and you are able to spend maybe an hour a day just to read what is happening in the world and to keep up to date with the companies in your portfolio and monitor them, you don't need more than 15, 20 companies, and that's the outer limit.
I think that's fantastic advice, man. And I just want to say thank you so much for sharing your morning. I know you're over in the Hong Kong area of the world. Oh, speaking of, really quick before I let you go, what do you use the Hong Kong exchange to invest into these U.S. stocks, or do you as a U.S. broker, or how does that whole process work for you?
I buy the Hong Kong listed shares in Hong Kong, and the rest I buy in the U.S., on the New York Stock Exchange and the NASDAQ.
Gotcha. What's your feelings and thoughts on just like some of these Chinese companies like Alibaba or not Alibaba, that's probably an obvious one, but let's look at iQIYI. Do you have any thoughts on that one?
Yeah, I used to own that. I owned it, I think, for about a year, and then I got out of the recent earnings announcement because we just didn't like the earnings report, and I took, I think, a 25% loss on the investment, which is one of my bigger losses over the last few years. But at their TAM, you know, the total addressable market, and the fact that they've already captured maybe 50% of the households in China with a broadband connection, plus their rising costs and the fact that the advertising business has pretty much come to a standstill. I just don't like that combination. So I've basically taken my loss and moved on. Having said that, I do have exposure to China, Jeremy. I've got about, I think, 25, 28% of my portfolio investing in Chinese companies. You know, so I have a position in Alibaba. I own Tencent. I've got the TAL Education and New Oriental Education, which are two really high growth education businesses, kindergarten tuition businesses.
Is that what
And, you know,
TAL does? Yeah. What do they do? Like, I know they're in the education firm. Is that that's not VIP kids. They don't have anything to do with that, do they?
no, they basically do after school tuition classes for,
Wow.
you know, school kids and exam prep courses and so forth. Both these
Wow.
both these companies are growing like crazy. You know, the top lines are growing at maybe 25, 30, 40% a year.
Mm.
And TAL and New Oriental Education, these are the two biggest players.
Mm-hmm.
Combined, I think they own or control less than 6, 7% of the total market in China. So there is a lot of scope for growth in a lot of cities. And education is a very, very non-cyclical business. You know, no matter what happens to the economy, people want their kids to do well in school. So they spend money, especially in Asia,
Yeah.
on educating the children because there is so much competition in terms of the number of people. So I just view these two companies as a very, very solid or strong growth opportunities over the next several years. And I've got exposure to Baozun in China, which is the Chinese equivalent of Shopify.
Yes.
And that is
Yes.
trading at a ratio of sort of zero point 0.8, and it's growing top line at sort of 40% a year or something.
Yep.
So an insane amount of growth and very, very cheap sort of valuation.
Very cheap.
I own telemedicine business also in China. They've started, you know, about a couple of years ago, 3, 4 years ago in telemedicine. So it's the equivalent of Teledoc in China.
Mm.
Yes, these are some of my investments in China, all the high growth stuff.
Yeah. Thanks for being so transparent, man. I really appreciate that. And thank you for telling me about the loss on IQ because yeah, man, if we're going to be an investor, we're going to lose. You know, you're going to have things you got to cut. Like you can't have that one stock that just turns bad because as you both know, one company can make you and one company can break you. And if you just hold on to it too long and it just goes under, like there's no reason to pull a Sears or a JC Penney. You know, once it starts just killing you, you got to bail at some point. You got to pull that trigger, pull that ripcord, rip the Band-Aid off, and kind of move on. So thanks for sharing that with me. And honestly, I love this. Like I would love to chat with you again at some point in the future. But again, for anyone who's listening, make sure to give this gentleman a follow. Again, here's his Twitter handle. I know you can't see it right now, Puru, but I'm showing your Twitter. So make sure to check this guy out. I follow him, and I love a lot of your posts. And again, it's just really good insight. So thank you for sharing that. And did you have any questions for me at all?
Not at all, actually. It was nice talking to you. And again, just give me a shout.
Likewise, man. I will. Thank you so much for your time. I really appreciate it.
Okay, thanks very much,
All
Jeremy.
right. You got it, buddy. Have a good day.
Yeah, take care. Bye.
All right. See you. Beautiful folks. And that is Mr. Puru Saxena. Just an incredible gentleman. Really kind. I love he's a little brash. You know, I like that. I like the fact that he doesn't really take a lot of crap from people. And on Twitter, he kind of stands up for what he believes in, and that's a good thing. I was in a futures trade while we were chatting. I wanted to just come over and check out, see what it's doing. It's coming back to a support. Okay, so let me look at this on the 15-minute. So what I'll probably end up doing on this one is it's likely going to come down here and stop out everyone who's out and bounce, and then I'll most likely move the stop and then get out. I had a feeling I should have exited right there for about a very small gain. So right now I'm at break even. It's at 280, 212 is the entry. I don't think I'm gonna hold this one much longer. I might go to bed and just leave this one alone and see if it can run. I'm gonna look at a few more charts and things of that nature, but we shall see. Anyway. There's my boy. There's Puru. He's an incredible guy. Folks from around the world, thanks so much for tuning in. You absolutely rock. Thanks for being a part of the real life trading community. And if you're listening in and you haven't already figured it out, you can also follow me on Twitter. My Twitter handle is @Newsome Nuggets because I drop nuggets of wisdom all day, every day. folks around the world, you rock. I'll see you later. Bye.